Okay then guys, welcome back ladies and gentlemen for another YouTube video. Allincrypto here, and today we have an interesting video lined up for you. It's going to be rather a rambly one, and you guys that are regular viewers of my channel will know that I love to ramble. We do it every single day in our daily market updates where we share our thoughts on everything with you guys. And this is going to be a video talking about the current macro environment that we're in, talking about the issues that we are facing, most notably with the largest market in the world, which is the debt markets, and talking about the inevitability that central banks are going to have to revert back to quantitative easing and turning the money printer back on. And turning the money printer back on comes in the form of many different things. The issuance of new debt. I believe debt is the focus, the center of liquidity. And I actually believe that the debt markets, certainly the sovereign treasury debt markets, are the priority over inflation, over pretty much everything for central banks. And the fact that we are seeing real pain and capitulation in those markets at a time where yields look set to continue to rise and the Fed is continuing to forward guide on their quantitative tightening stance, even though you could argue there is a bit of quantitative easing going on in regards to the Treasury now taking that role, which is a very intricate thing to get into, and there's lots of moving parts to. That we are now getting to a point, I believe, where the Fed, and I think the market's already sensing this, are coming to an end, and actually we're entering more and more of a zone where they're actually likely going to have to revert. And I think markets being forward guidance are noticing this. We were exceptionally early and accurate on our calls for a bullish period for the stock market going into 2023, and of course the cryptocurrency space. And we're predominantly crypto investors. We're also traders. But we were very good on these calls, and this factors into it. You know, the macro, of course, factors into it. It is if you look at the food chain of kind of assets, you've got debt right at the top. We've also done quite a bit of looking at the likes of real estate recently in regards to some of the ETFs that we've got. And that, of course, got smashed on the forward guidance of the Federal Reserve's recent meeting, which was they were going to be tighter for longer. And they actually priced out in regards to the dot plot a couple of interest rate cuts next year and signal potentially one more. And with real estate, with debt doing what it's doing, of course, the dollar has had this is a 3-month chart, so probably not the best way to view it, a very good time period or a very good time. So what we're going to be doing in this video is looking at a number of things, talking about the bigger markets and speculating that actually they are going to have to, there's an inevitability with how the system works. And that is that it is a proliferation system. So first of all, you need to understand, which is why many of us are here in the crypto space, how the fiat systems work and the issues that there are with it. Okay, so fiat is borrowed into existence under the current system. Whenever there is a new money issued, and we can see this looking at the M2, which is in line with the debt markets that are a form of liquidity. You can say they're very similar to M2, although not physical money. They're the asset that backs it. When money is borrowed into existence, you have the money, and then you have the liability on the back end of it, which is the bond market. Treasuries are the cornerstone of economies. Certainly in the current day, this might not always have been the case, but it certainly is today. So every pension, every major institution, investment fund, whatever it is typically stuffed, and there's been this 60-40 split with bonds. And it's been the right trade for the past 40 years. Now, this is TLT, which is the bond market. This is a representation of 20-year plus treasuries, which has been getting smashed recently. And we'll look at this and bring a few more charts onto this. But a better way to perhaps look at this is looking at something like the 10-year. Okay, so this is, and we'll put it on a 3-monthly chart because it's quite a long chart. Essentially, for the past 40 years, this is the yields which go down when bonds go up. The Federal Reserve has not only been putting into existence more and more debt, but they've also been a continued buyer of it and an injector into liquidity. It's why if we take the M2 off, you look at the stock market, it's adversely correlated with this. Okay. And you can see that stocks, markets generally have gone up with the money supply and with the issuance of debt. Right now, we're in an extremely interesting predicament, and that is that debt, nobody wants the debt right now. And we have already seen 2 counts of, during this tightening cycle, central banks step in, and they will do again if this continues, and we're getting closer and closer to talking about yield curve controls. Central banks step in and actually look to help the problem out. In the UK, it was the gilts market. We saw a real spike in gilt yields and a drop in, and gilts are just basically treasuries. Let's use the UK 10-year. You know, we had this capitulation, and that caused the Bank of England to actually step in and to help and to basically agree to buy up those bonds and provide liquidity in that form. Okay, because they're due to inflation, everyone's very tight. They don't want to do that. The problem is then who buys the bonds? And we saw them step in and do that in the UK in the form of propping up the gilts market, and we also saw the US, going back to TLT, do that here in the forms of Silicon Valley Bank and some of the other banks that essentially or coming out and basically providing liquidity in regards to some of the other kind of banking issues that we had that you could say were related to bonds or not. Every bank, every pension, everyone is stuffed with bonds, right? And right now the bond market is doing this and putting pressure on things. This was from JP Morgan. So we are not saying that the situation now is the same as 2017 or 2007, 2008, but signs of stress are beginning to appear. Lags are longer this time, and this is why we ultimately don't think a crash comes till later on. You know, we looked at a great study where it said actually the medium lag over multiple papers is anywhere up to 50 months in developed economies, 25 to 50 months for the lagged effects to take place. But signs of stress appear. Lags are longer this time, which has resulted in complacency and broad acceptance of a soft landing or even a no landing thesis. So your soft landing thesis, and we'll look at a number of other things, is that this starts to happen. Okay? And that inflation subsides and you get that natural bidder of buyers back into the bond market. The hard landing is you end up with a macrocosm of Silicon Valley Bank that's caused by further capitulation with this. That will be painful and cause certainly 2008 style fills in terms of insolvency. However, the result ultimately for that is, and whichever way you look at this, soft, hard, no landing, the last buyer of resort is always going to be the Federal Reserve of their own system. The entire monetary system centers around, in the United States, in the UK, whatever central bank it is, debt, treasuries, and the propping up of those. Because if you allow them to fall too much, your entire financial system is essentially undermined. You know, we live, fiat systems are a debt-based system. And the debt right now, nobody wants. And this is where the uncertainty and the trickiness of markets is coming from. And what's the path out of here is the main question that we have. I know we're only crypto investors and we're the plankton in regards to this food chain, but we have to ask ourselves, how does this market resolve? And why would you go into debt right now, even though you have high yields and their actual nominal value is losing, when you can actually just stick your money into the likes of the dollar and gain a very good yield on it with no risk at all? It's the same issue that assets suffer with. So the correlation between the Fed for the past 40 years doing this, you can see the S&P. If you look at the US money supply, you can see actually this is completely in line with this, and it's very natural. If money is the asset that's produced with the liability as money's created, you can see that naturally as they release more treasuries into the market, the money supply is going to inflate on the back end of that. This is the issue with markets and why they've stalled like they have, and why we've got so much uncertainty with how they're trying to work themselves out, because this is a major move. If you look at the Federal Reserve's balance sheet, again, we'll take the other two off, it paints a very, very clear picture. And the only jump that we saw was here, which we said was Silicon Valley Bank and a number of other things. And actually, if you look at the S&P, where did the S&P jump? So these markets, when we talk about the food chain, the bond markets are right at the top, and figuring out how they resolve themselves is the question. It is the focal point of how things shape out in the future. Do we get that hard landing, which is capitulation in the bond markets, essentially, yield spiking up, which actually some of them look like they want to do, and then contagion and fallout of that on a macrocosm of the microcosm that we saw with Silicon Valley Bank? Or do we get that natural bidder of buyers into the market? Or do the Fed, having done their task, these are both soft landing scenarios, now come back in and start to support, and we're off to the races again? Each road leads to Jerusalem, unfortunately, guys. Each road leads to the propping up of the fiat systems that aren't debt systems. You have to back the debt. If you don't, everything capitulates. And this is why Bitcoin has been nothing short of and is a triumph, because it exists even though affected by it, it exists entirely outside of it. It's out of their control. Potentially, you could argue that because of the dollar denominated value in there, but it transcends the dollar. Look at how it's doing against the Argentina peso and other things like that. So this was an important video for me to make. And the inevitability, again, and I really want to stress this, is that they have to go back to printing. I want to pull up another tweet here. This is from Cross Border Capitals. If anybody knows this individual, please reach out. We'd love to have him on the show. We think he's absolutely great. We may be closer to breaking point, but mortgage markets may also be anticipated coming higher yields. There's a lot of really interesting things going on. Why did property, again, look at property with these markets to take them off. Why did property get hit so hard? Well, because it's a very interest rate. These are all the ETFs that we look at, by the way, guys. It's a very interest rate sensitive game. And they all got hit on the back end of the Fed speech, along with yields pushing higher, which we've been expecting, and debt pushing lower. So when do the Fed have to start treading? And I think they've already started to tread a lot more carefully. But that's going to become more and more apparent as the Treasury keeps issuing more debt. So they're kind of doing QE. The price on all of that debt is astronomical, which leads to the issuance of more debt. It's almost a double-edged sword. Quantitative tightening in certain areas actually crosses over to quantitative easing, because you have to facilitate the payment of that colossal debt that you are causing, and that becomes inflationary in itself. So there is no way out for this system other than an entire collapse than continued proliferation of the debt that backs the US dollar, and thus the US dollar itself. And if we look at money supply, you can see very clearly, it's probably better illustrated, like I say, on the yields. This has been doing this whilst they've been issuing and continuing to back debt. This is the bonds, of course. We could almost invert this. And now there's this very uncertain period. And the historical correlation between equities and bonds is they've gone up together because the Fed's had your back, and TINA has been applicable. However, there is now an alternative to TINA, and that is in the form of just holding your money in cash and getting the reserves on it. And with inflation continuing to raise its head, the main question I think here is, okay, soft, no, or hard landing, they're going to have to go back to solving this equation. There's no other alternative. Otherwise, the entire monetary system collapses. And unless they actively want that and are actively trying to do that, and why would they do that when they've got the option to print? And right now they're not printing because of inflation. Of course, it would fuel inflation, but they are running out of runway. And this is the questions that we've got to be asking ourselves. And of course, the equity market on the back end of inflation fears and continued rise in the bond market and trouble, it's kind of stalling out until it kind of sorts itself out. And the question is for us, how is it going to sort itself out? Really interesting tweet here that I'd like to read to kind of close out on. The problem I have with the bearish doomsday scenarios on FinTwit is that they ignore the ability and willingness of the Fed to act. This is important. I think he covers some really great points here. Central banks have removed the left tail risk that you're betting on. So we should probably do a video on left and right tail risks, and it's a kind of financial term, but a confusing one that we'll probably skip over for this video. Liquidity will be injected when things start to break. It doesn't matter if those interventions contradict tightening policies, US banking crisis, 400 billion of liquidity support measured in 2 weeks. So what is he talking about? He's talking about what we've just highlighted, which happened here, which was, of course, Silicon Valley Bank. They stepped in because they have no other choice. The Fed is in the corner. Central banks are in the corner, and Bitcoin's got them on the ropes. No, I'm joking. But we do actually think that Bitcoin, and we'll look at something interesting in just a second, is a genuine way out of a lot of this, because it's an alternative system. We like gold bugs, but actually if you divide gold by the... we think gold and Bitcoin bugs are fighting the same fight, essentially, the corrupt fiat fight. But if you actually look at gold divided by the money supply, it's lackluster. You know, you've not been right as a gold investor, I don't think, for a long time. Whether you eventually do on the collapse of something, which is a possibility, I just don't think. I think the Fed will act, and they'll put in controls, just like we've seen them do thus far with what this individual is talking about, in regards to propping up this market. They injected $40 billion, $400 billion on the back end of Silicon Valley Bank, First Republic failing, which they say was a liquidity issue due to actually debt devaluation. And they supported that. They injected that liquidity. Look at where it is today. It's rolled over since then. He talks then about UK gilts crisis, Bank of England emergency bond buying program. Gilts, let's pop this sucker up again. Gilts are treasuries. And this is, no, okay, this is just 10 year. Can take this off now. This happened. Bank of England instantly stepped in and propped it up. They will do the same thing again. They have no other choice. And it's why, this is why, not because necessarily of inflation, although on the face of it, it is, and that's what they're all saying. This is why now the Bank of England and other banks aren't coming out and continuing to raise rates, because they know that this has more implications in regards to pain and panic than actual inflation itself does. Because everyone, your pensions, your banks, your financial institutions, your investment broker, they are all stuffed with this poison that is debt, that is the very fiat system itself. And certainly dollar debt, we've not even spoken about the geo sort of landscape of that. And how you've got people really trying to get rid of it, like China, et cetera, et cetera. And remember, Yellen went over to China. No one really knows exactly why that was, but that's for another video. So there's an ultimate toolbox of not QE measures. Fiat currency will ultimately be the escape valve. Real assets will moon in fiat terms, as they have continued to do over 40 years. This is not a sustainable path unless you are trying to entirely collapse on a greater scale than ever seen everything. And maybe that is their agenda, but I happen to think that they're going to do QE. I don't happen to think they're going to let this sucker, blow up here until they've got a alternative in place. We are going to end up on a new monetary system. I just don't think it's yet, because it's too obvious. Bitcoin is currently stable. Stability coincides with a questioning of US debt sustainability. This differs from yields rising on a credible Fed hiking cycle. The Fed cycle is dumb. We have been speculating on that quite a bit. This also not about renewing inflation fears on oil. Break even barely moved. Bitcoin is telling us we're near a pivot point. The tail risk you should position for is on the right. Yes, I happen to agree. So the right side tail risk is actually more of a positive tail risk for assets than the left. We agree. And with Twitter, we find ourselves, even though we think FinTwit is both the best and the worst possible place to get information, it is one of the best also. There's no doubt about that. We find ourselves absolutely agreeing. There's many aspects of my own thoughts on how the world and monetary policy works that are embodied in tweets, and we think this is very similar. So this is what this is all about. This is going to dictate your hard, soft, or no landing. Regardless of those, whether just using the gilts because we're on here as an example, this happens, which is likely going to come to the tune of crying in the street because pensions will go insolvent. This will happen, that will happen. Banks themselves will go insolvent, and then they'll have no other choice but to step in like they did here. Or whether they say, okay, we're going to keep policy where it is. Maybe we tolerate higher inflation. That's kind of your soft to no landing. But this has to go up. Bonds have to go up because if they don't, the fallout, I can tell you, is far worse than a 9% inflation. And then we've not actually even spoken about the yield curve, which is predicting a crash. It's been 100% right. What we got going on here? Let's actually get rid of these now. But at what point do we come back and start talking about yield controls? Actually, I've not looked at this, but this is concerning. And this is telling you that things may want to sort themselves out. Crashes occur. You can see we've done this really scribbly chart at the point of uninversion. And this is ultimately why we actually agree with David Hunter, believe it or not. I think it was incredibly wrong in 2022 that the crash isn't coming for a while and you're going to end up in some sort of blow off top. We've already been validated on many of our stocks. One of the few people that understand this. Guys, an economist is just someone with an opinion. There's nothing special. You don't need a qualification to be an economist. But what you do potentially need is credibility in terms of being right and wrong. And hopefully we're showing people that. This hit our target perfectly and we were bullish down here. Just like we've been with stocks. Yes, stocks went in the correction. Do they need to come back? We'll see. You know, and we can do a whole video if anybody likes these kind of macro-y rants in regards to interest rates and their correlation with the markets. The last thing perhaps that I just want to finish on is really reiterating that point that this has to get a bid at some point. Otherwise, everything, you know, the financial system itself gets called into question. And they care about that more than they do anything. And notice how they're becoming very cautious, knowing that things aren't getting a bid. They are going to have to start turning around. And I think markets are sniffing this. I think there's a lot of people like JP Morgan call for 7% yields. You may get that. Look, you can see these are both two breakouts that we've watched, both breaking out. But we will see. And there is a whole geopolitical side of this that we could talk about, but we're not going to for the sake of the video. Last thing I want to talk about, just in regards to how much of a success Bitcoin's been, this is Bitcoin divided by the money supply. This is the SPY. Despite the money supply, it's still where it was just before the March 2020 slam. This is real estate. Tesla. The only thing that's really outperformed the money supply, or outperformed in relation to the money supply, divided by the money supply, I should say, is Bitcoin and tech stocks. Gold, I'm afraid, hate or love me, has been losing in purchasing power in relation to when divided by the money supply, whereas Bitcoin hasn't. Hate to say it, but I kind of agree with a lot of the points that Michael Saylor's making at the moment, even though I think there's this whole kind of glitz and glam thing with it. I think we've gone on for long enough, guys. This was just a video to kind of just confirm to people that this is what's going on in the macro. This is the big issue. This is how it's going to get resolved in a number of ways, hard, soft, or no landing. The inevitability is that they come back and print and proliferate the very thing that we weigh our assets up against, which means that they'll do well. On that note, I'm going to love and leave you. Hopefully you've enjoyed the ranty video. Let me know if you want more of these. See you in the next one.